Before we begin, I need to share something important with you. Everything I'm about to share with you today is general information only. It's not personal financial advice. Your situation is unique. Always speak with a licensed financial advisor before making any decisions about your money. Now, let's get started. I've been in this industry for over 20 years, and there's one conversation that comes up again and again. It's the conversation nobody wants to have. It's about what happens when we're gone. It's about funerals, and more specifically, it's about funeral insurance. I can see the weight on your shoulders. You don't want to be a burden. You don't want your children scrambling to find $10,000 or $15,000 when they're already grieving. You've seen the ads on television, the ones with the gentle music, the ones that promise peace of mind for just a few dollars a week, and you've wondered, is this the right thing to do? Should I sign up? Let me tell you something right now. You're asking exactly the right questions, because the truth about funeral insurance might surprise you. It might even shock you. And by the end of our time together today, you're going to understand exactly what you're really buying when you sign that policy. More importantly, you'll know whether there's a better way. Take a breath. You're not alone in this. Thousands of Australians just like you are wrestling with this exact same decision right now, and I'm here to walk you through it, step by step. No jargon, no confusion, just the truth. Let's start by going back in time, just for a moment. Think about Australia 30 or 40 years ago. Back then, funerals were simpler affairs. They cost less, much less. A basic funeral might have set a family back $2,000 or $3,000. That was still a lot of money, but it was manageable. And here's something else. Back then, more Australians had what we called defined benefit superannuation. Your employer contributed, you contributed, and when you passed away, there was often a death benefit built right in. Your family received a lump sum, automatically. It covered the funeral, it helped with expenses. The system, imperfect as it was, had some safety nets built in. Insurance companies noticed something. They noticed that Australians were living longer. They noticed that funerals were becoming more expensive. They noticed that people were worried, and they saw an opportunity. Not necessarily a bad thing, mind you, but an opportunity nonetheless. Funeral insurance started appearing more widely in the 1990s and 2000s. The pitch was simple. Pay us a small amount each week or each month. When you pass away, we'll pay out a lump sum. Your family won't have to worry. It sounded perfect. But then something happened. The cost of funerals kept rising. Inflation kept climbing. And here's the critical part. Those premiums you were paying, they kept rising too, often faster than inflation, often faster than you expected. Fast forward to today, right now, Australia in 2025. The average funeral costs anywhere from $7,000 to $15,000, sometimes more, depending on what you choose. Burial or cremation, the coffin, the flowers, the venue, the death certificate fees, it adds up quickly. Meanwhile, we're living in uncertain economic times. Interest rates have been volatile. The cost of living is squeezing household budgets. You're watching every dollar. And those funeral insurance premiums that seemed small 10 years ago, they might have doubled or tripled. This is the Australian context we're operating in right now. It's not the Australia of our parents' generation. It's a different landscape. And that means we need to think differently about how we plan for end-of-life expenses. Now let's get into the details. What exactly is funeral insurance? At its core, it's a type of life insurance, but it's very specific. It's designed to pay out a fixed amount when you die. That amount is meant to cover funeral costs. Here's how it typically works. You choose a level of cover, maybe $10,000, maybe $15,000. You start paying premiums, usually weekly or monthly. Those premiums are deducted from your bank account or your Centrelink payment. Now here's the first critical detail. Most funeral insurance policies are what we call guaranteed acceptance. That means they don't require a medical examination. They don't ask detailed health questions. They'll accept you even if you have serious health conditions. Sounds good, right? But here's what that really means. The insurance company is taking on more risk. They're insuring people they know are likely to claim sooner rather than later. And how do insurance companies manage risk? They charge higher premiums, much higher than standard life insurance. Let me give you some context. A healthy 60-year-old might pay $15 to $20 per month for a small term life insurance policy. But that same person might pay $40 to $60 per month for funeral insurance. Why? Because the insurance company isn't assessing your individual risk. They're pricing for the whole pool. And that pool includes people with serious health issues. Here's another detail. Most funeral insurance policies have what's called a waiting period, usually 12 to 24 months. If you die during that waiting period from natural causes, the policy might not pay out the full amount. It might only refund your premiums, maybe with a small amount of interest. If you die from an accident during the waiting period, that's usually different. Most policies will pay out in full. But death from illness? You need to survive past that waiting period. And here's something most people don't realize. Funeral insurance premiums almost never stay the same. They're what we call stepped premiums. They increase as you get older. Every year or every few years, your premium goes up, sometimes by 5%, sometimes by 10%, sometimes more. Let me paint you a picture. You're 65. You take out a policy with a $10,000 benefit. You pay $50 per month. That's $600 per year. Seems reasonable. But 10 years later, you're 75. Your premium has increased to $90 per month. That's $1,080 per year, and it keeps climbing. By the time you're 85, if you're still paying, you might be paying $150 per month. That's $1,800 per year. Over those 20 years, you've paid more than $24,000 in premiums for a $10,000 benefit. Do you see the problem? You've paid out more than double what your family will receive, and you're still paying. Because if you stop paying, you lose everything. There's no cash value, there's no refund. It's gone. This is what the industry calls premium leakage. Your money is leaking away, month after month, year after year. Now, I'm not saying funeral insurance is always a bad choice. For some people, in some situations, it makes sense. But you need to understand exactly what you're buying. You need to go in with your eyes wide open. Let me tell you about Bruce and Jenny. They're not real people, but their story is based on real situations I've seen dozens of times. Bruce is 68, Jenny is 66. They're retired. They own their home outright in the outer suburbs of Melbourne. Their superannuation is modest, about $180,000 combined. They're getting the age pension. They're comfortable, but not wealthy. They watch every dollar. One evening, they're watching television. An ad comes on. A grandfather playing with his grandchildren. A gentle voice talks about not being a burden, about giving your family peace of mind. Bruce looks at Jenny. Jenny looks at Bruce. They both know they need to think about this. The next day, Jenny calls the number from the ad. The person on the phone is friendly, helpful. They explain the policy, $10,000 of cover each. The premium starts at $45 per month for Bruce, $40 per month for Jenny, $85 per month total. They can afford that. Jenny asks about the small print. The person explains there's a 2-year waiting period for natural causes, but after that, they're covered for life, as long as they keep paying. It sounds good. They sign up. Year 1, they pay $1,020 in premiums. No problems. They're happy. They've taken care of their responsibility. Year 3, their premiums have increased to $95 per month. They're now paying $1,140 per year. They're a bit surprised, but they keep paying. They've already invested over $3,000. They can't stop now. Year 5. Bruce has a health scare. Nothing life-threatening, but it reminds them both that time is precious. Their premiums are now $110 per month, $1,320 per year. They've paid over $6,000 in total now. Year 8. Jenny's sister passes away. The funeral costs $13,000. Jenny and Bruce attend. They see how stressful it is. They feel grateful they have their insurance sorted. Their premiums are now $135 per month, but they keep paying. Year 12. Bruce is now 80. Jenny is 78. Their premiums have climbed to $180 per month, $2,160 per year. Over the 12 years, they've paid approximately $17,000 in premiums for $20,000 of cover. And here's the difficult truth. If Bruce passed away tomorrow, his policy would pay out $10,000, but they've already paid $17,000. The policy has cost them more than it will ever return. Now, let's look at an alternative path. Let's rewind. Let's imagine Bruce and Jenny made a different choice back when they were 68 and 66. Instead of taking out funeral insurance, they decided to save. They set up a separate savings account. They called it their funeral fund. They committed to putting $85 per month into that account, the same amount they would have paid in premiums. Year 1. They deposit $1,020. Even at a modest interest rate of 3%, they end the year with just over $1,000 in the account. Year 3. They've deposited $3,060. With interest, they have around $3,200 saved. Year 5. They've deposited around $5,800. With compound interest, they have approximately $6,100 in the account. Year 8. They've deposited close to $9,800. With interest, they have over $10,000 saved. They've reached their original goal. And the best part? That money is theirs. They can access it if they need it. They can stop contributing if they want. It's flexible. Year 12. If they kept contributing, they'd have around $16,000 saved, maybe more, depending on interest rates. And that money doesn't disappear when they stop contributing. It doesn't get smaller. It's there, solid, real. Can you see the difference? One approach drains money away. The other builds an asset. Now, I can hear some of you thinking, but what if I die in year 2? What if I die in year 3? The insurance would pay out $10,000. My savings account would only have $2,000 or $3,000. That's a fair point, and it's the gamble funeral insurance companies are betting on. They're betting most people will live long enough that the premiums paid exceed the benefit. And statistically, they're right most of the time. But here's another way to think about it. If you're truly worried about dying in the first few years and you want insurance for that period, there might be better options. A small term life insurance policy, if you can qualify medically, or a very short-term funeral insurance policy that you plan to cancel once you've built up your savings. And here's something else. Many Australians already have some life insurance through their superannuation fund. Did you know that? It's often built in automatically. You might have $10,000, $20,000, maybe more. Check your super statement. You might already be covered. If you do have insurance through super, think carefully before taking out additional funeral insurance. You might be doubling up, paying for coverage you already have. Let me share another scenario. This one is about Margaret. She's 73, widowed. She lives alone in a unit in Brisbane. Her superannuation is small, about $40,000. She gets the age pension. Her children live interstate. Margaret is terrified of being a burden. She took out funeral insurance 15 years ago when she was 58. She's been paying faithfully ever since. Her premium started at $35 per month. It's now $120 per month. Over 15 years, she's paid approximately $12,000 in premiums. Her benefit is $8,000. She's paid more than the benefit is worth. But she's scared to cancel. She thinks if she stops, all that money is wasted. This is what we call the sunk cost fallacy. The money is already gone. It's already spent. Whether Margaret continues or cancels, she can't get that $12,000 back. The question isn't what she's already paid. The question is what makes sense going forward. If Margaret cancels the policy and puts that $120 per month into savings, in 5 years she'll have saved over $7,000, plus interest. That's almost as much as her benefit. And if she lives another 10 years, which is entirely possible, she'll have saved over $14,000. She'll be better off. But Margaret doesn't know this. No one has explained it to her. She keeps paying, month after month. The insurance company keeps collecting. So what should you do? What are the actual solutions here? First, take stock of what you already have. Pull out your superannuation statements, all of them. Look for life insurance or death benefits. Many super funds include automatic cover. You might already have $5,000, $10,000, or $20,000 of life insurance. If you do, that might be enough to cover your funeral. Right there. Done. Second, check with Centrelink about any funeral assistance. Depending on your situation, there may be some limited help available. It's not a lot, but every bit helps. The bereavement payment can assist with immediate costs. Third, talk to your family. I know this is uncomfortable. I know it feels morbid, but open the conversation. Ask them what they would want for your funeral. You might be surprised. Many adult children will say they want something simple. They don't need an expensive coffin or an elaborate service. They want to honor you in their own way. Knowing their preferences might change how much you think you need to save. Fourth, if you genuinely have no savings and no super and you're in poor health, funeral insurance might be an option. But please, please compare multiple providers. Read the fine print. Understand when the premiums increase. Ask about the total amount you'll pay over your lifetime. Do the math. Fifth, consider a funeral bond. This is different from funeral insurance. A funeral bond is a savings product. You make deposits. The money grows with interest. When you pass away, the funds are used to pay for your funeral. The key difference? You're building an asset. If you contribute $5,000 over time, you'll have at least $5,000 in the bond, plus growth. It's not a gamble. It's a savings vehicle with tax advantages. Funeral bonds have some attractive features. The first, up to about $15,000, is exempt from the age pension assets test. That means it won't affect your pension entitlement. That's significant. And the money can only be used for funeral expenses, which gives you peace of mind that it won't be spent on other things. Sixth, consider prepaying your funeral. Some funeral directors allow you to prepay. You lock in today's prices. You choose exactly what you want. The money is held in trust. When you pass away, the funeral is already paid for. This can be a good option if you have a lump sum available and you want certainty. But be careful. Make sure the funeral director is reputable. Make sure the funds are properly protected. You don't want to prepay only to find the business has closed down when the time comes. Seventh, and this is my preferred option for most people, start a dedicated savings account. Call it your funeral fund. Set up an automatic transfer, $50 per month, $100 per month, whatever you can comfortably afford. Treat it like any other bill, non-negotiable. The beautiful thing about saving is flexibility. If an emergency comes up and you need that money, it's there. If you live to 95 and you've saved $30,000, that money doesn't vanish. It becomes part of your estate. Your children inherit it. They can use it for your funeral and keep the rest. With insurance, you get the benefit amount and nothing more, even if you've paid double or triple that amount over the years. Let me be really practical now. If you currently have funeral insurance, here's what I want you to do. Get out your policy documents. Find them. Read them. Look for the following things. What is your current benefit amount? Write it down. What is your current monthly or weekly premium? Write it down. How long have you been paying? Calculate the total amount you've paid so far. Write it down. Look at the policy schedule. How much will your premiums increase each year? If it doesn't say exactly, call the insurance company and ask. Write it down. Now do some math. If you continue paying until you're 85 or 90, how much will you have paid in total? There are calculators online that can help with this, or ask a financially savvy friend or family member to help. Compare that total amount to your benefit. If you're going to pay out $20,000 for a $10,000 benefit, that policy is not working in your favor. If that's the case, consider canceling. Yes, you'll lose what you've already paid, but you'll stop the bleeding. You'll stop throwing good money after bad, and you can redirect those premium payments into savings. Now, if you've only been paying for a year or two and the numbers still make sense, maybe you keep it for now, but set a reminder to review it every single year. Don't let it run on autopilot for a decade. Here's another strategy. If you're married or in a partnership, you might each have a policy. Consider canceling one policy, keep the other. Take the money you're saving from the canceled policy and put it into a funeral fund. You're building savings while maintaining some insurance coverage. It's a hybrid approach. Or, if your health is reasonable, consider applying for a small term life insurance policy through a financial advisor. If you qualify medically, the premiums will likely be lower than funeral insurance. You get more value for your dollar. And some term policies can convert to whole-of-life policies later if needed. I also want to talk about guilt. You might feel guilty about the idea of not having insurance. You might feel like you're being irresponsible, like you're failing your family. Let me tell you something. Taking control of your finances is not irresponsible. It's the opposite. Your family doesn't want you to struggle financially in your final years just to pay for insurance. They don't want you skipping meals or missing out on small joys because you're paying premiums that don't make financial sense. They want you to be secure. They want you to be comfortable. They love you. And here's a truth that might feel uncomfortable. If your family can't come up with $7,000 or $10,000 between them to cover your funeral, then they're facing financial challenges that go far beyond funeral costs. In that case, your insurance payout might be a Band-Aid on a much bigger problem. It might be better to use that premium money now to help them build their own financial stability, or to strengthen your own emergency fund so you can help them in a crisis. I know this sounds harsh, but it's reality. We need to think clearly about these things. Let's talk about what a funeral actually costs. This helps you plan realistically. A basic cremation can cost as little as $2,000 to $4,000 if you choose a simple option. No service at the crematorium, no fancy coffin, just a basic container. The family holds a memorial at home or at a park. That's completely valid. That's completely acceptable. A standard funeral with cremation, a service at the crematorium, a mid-range coffin, death certificates, and basic flowers might cost $7,000 to $10,000. A more elaborate funeral with burial, a premium coffin, church service, catering, flowers, and other extras can easily reach $15,000 to $20,000 or more. Here's what I want you to understand. You get to decide. You get to tell your family what you want. If you'd be happy with a simple cremation and a memorial gathering at someone's home, tell them that. Write it down. Put it with your important documents. That knowledge alone might reduce how much you feel you need to save or insure. Some people prepay for a simple cremation. It might cost $3,000 today. Done. Sort it. Then they save a little extra for a wake or a memorial. Total cost, maybe $4,000 or $5,000. That's achievable through savings alone. Don't let the funeral industry upsell you or your family. Yes, funerals are important. Yes, they help with grief. But an expensive coffin doesn't mean you loved the person more. A big funeral doesn't measure the quality of a life lived. Your family will remember you for who you were, not for how much they spent on your funeral. Now let's talk about legacy, because this isn't just about funerals. It's about what you leave behind, financially, emotionally, spiritually. every dollar you spend on funeral insurance premiums that exceed the benefit is a dollar that doesn't go to your grandchildren. It's a dollar that doesn't help your children. It's a dollar that doesn't sit in your bank account giving you security and options in your final years. I've seen too many retirees living lean, stressing about money, while they're paying hundreds of dollars per month in insurance premiums. That money could be going toward a night out with family, a small holiday, a grandchild's birthday present, things that create memories right now, things that matter. Because here's the ultimate truth. You're not going to be at your funeral. You won't see the flowers. You won't hear the eulogy. What you will experience is the years leading up to that day, and those years should be as rich and full and joyful as possible. If paying for funeral insurance gives you genuine peace of mind and you can truly afford it and the numbers make sense, then fine. But if you're paying for it out of fear, out of guilt, out of a sense that you should, then stop. Make a different choice, a choice that serves you and your family better. We're coming to the end of our time together, and I want to leave you with something bigger than just funeral insurance. I want to talk about your third act, this phase of life you're in right now, the years after retirement, the years of grandchildren and gardens, and maybe a little travel and quiet mornings and cups of tea. This is not the waiting room. This is not the end. This is a whole chapter, a whole act, and it deserves to be lived fully, with confidence, with joy, with freedom from unnecessary fear. Yes, plan for your funeral. Be responsible, but don't let that planning consume you. Don't let it drain your resources. Don't let it steal the peace and contentment you've earned. You've worked your whole life. You've raised families. You've contributed to this country. You've paid taxes. You've done your bit. And now you deserve to rest into this final chapter without financial stress, without being exploited, without being sold products that don't serve you. Take what I've shared today and sit with it. Talk to your partner. Talk to your children. Pull out those super statements. Review your funeral insurance policy if you have one. Do the math. Be honest about the numbers. And then make a decision. A conscious, informed decision. Not a decision based on fear or a slick television ad. A decision based on facts, based on your actual situation, based on what truly serves you and your loved ones. You're not alone in this. There are financial counselors available through organizations like the National Debt Helpline. Free services. If you're unsure about your policy, call them. They can review it with you. They have no interest in selling you anything. They're just there to help. You can also speak with a licensed financial advisor. Yes, there's usually a fee, but a one-off consultation might cost a few $100s and could save you thousands. It could give you clarity and confidence. That's money well spent. Remember, you're in control. You can cancel policies, you can start saving, you can change your mind. It's your money, it's your life, it's your decision. And whatever you decide, do it with your head held high. You're not being a burden, you're being thoughtful, you're being responsible, you're taking care of yourself and your family in the way that makes the most sense for your unique situation. Before I close, let me remind you one final time. Everything I've shared today is general information. It's educational. It's not personal financial advice tailored to your specific circumstances. Your situation is unique. You have your own health, your own assets, your own family dynamics. Always seek advice from a licensed professional before making financial decisions. But armed with the knowledge I've given you today, you're now equipped to ask the right questions. You understand the game. You understand the pitfalls. You can spot a bad deal, and you can make choices that truly serve you and your loved ones. So go forward, be confident, be informed, and live these precious years with financial peace and emotional freedom. You've earned it, you deserve it, and it's absolutely within your reach. Thank you for spending this time with me today. I hope it's been helpful. I hope it's given you clarity, and I hope it's given you the courage to take control of your financial future, whatever that looks like for you. Take care of yourself, and remember, you're doing just fine.